In this episode, we're going to focus our attention on two different variations of charitable remainder trusts. At the end of the episode, I'll touch briefly on another type of split interest trust called the charitable lead trusts. We're not going to spend too much time there, however, simply because they are far less common compared to charitable remainder trusts. But I at least want to make you aware that they exist and show how they differ from charitable remainder trusts. Charitable remainder trusts are irrevocable split interest trusts. So why are they called split interest trusts? It's because a portion of the trust is distributed to certain non-charitable trust beneficiaries. That's usually the grantor, the person who establishes the trust, or perhaps family members of that person. And another portion is at some point distributed to charity. Hence, the beneficiaries are split between charitable and non-charitable beneficiaries. Charitable remainder trusts are popular because they offer the grantor of the trust an immediate income tax deduction at the time that the trust is funded. After the trust is funded, the donor retains for himself or herself, or for the benefit of someone else, an income or annuity interest for a specific term. And then whatever amount remains in the trust after the term of the trust ends passes to a qualified charitable organization. The term of the trust can last for up to 20 years or for the lifetime of the beneficiaries. And the trust will specify whether the retained interest, that's the portion that is kept and distributed to the non-charitable beneficiaries, is either a fixed annual payment, and that annual payment or that amount is established when the trust is funded, or a percentage of the principal of the trust property, which is revalued each year. So a charitable remainder trust that retains a fixed annual payment is called a Charitable Retained Annuity Trust, sometimes called a CRAT in the alphabet soup of trust language. And a charitable remainder trust that retains an income interest in the form of a percentage of the trust principal is called a Charitable Retained Unitrust, or a CRUT. Let's explore the basic differences between a CRAT and a CRUT. Again, CRAT is a Charitable Retained Annuity Trust, and a CRUT is a Charitable Retained Unitrust. For a CRAT, the minimum annuity interest allowable is 5%, and the maximum is 50% of the value of the assets that are used to fund the trust. So generally, you multiply the total value of the trust assets by whatever percentage you choose, and that is the amount that's distributed year after year to the non-charitable beneficiaries for the entire term of the trust. And then whatever's left over after the term of the trust is distributed to charity. After funding a CRAT, additional contributions to the trust are not permitted. So once it's funded, you can't keep funding it. For a CRUT, the allowable distributions are similar: 5% minimum, 50% maximum. The difference is the multiplier. A CRUT distribution is based upon a percentage of the value of the trust assets, which is revalued each year. So what that means is that each year, the amount is adjusted by looking at the percentage of the trust to be distributed based upon its then current amount held in trust. Another difference between a CRAT and a CRUT is that with a CRUT, there's no prohibition against additional contributions into the trust. So you can continue to fund the trust, which offers more flexibility to use the same vehicle to get additional income tax deductions in the tax years that additional contributions are made. This makes the CRUT a more popular choice because it gives the donor more control over the payouts during the term of the trust. A few final notes on charitable remainder trusts. The purpose of them are twofold. So first, the beneficiary receives a payment stream for the duration of the trust, and the remainder interest passes to charity. And the donor may claim an immediate income tax deduction and a gift tax deduction for the remainder interest based upon its present value at the time that the trust is funded. From a tax savings perspective, it is ideal to fund the trust with highly appreciated assets because the trust is not subject to capital gains tax and neither is the charity. Now, there's a caveat to this. Distributions from the trust to the non-charitable beneficiaries are subject to tax, and the tax that's imposed is entirely dependent on what assets are in the trust and the character of income that is generated. So this gets sort of complicated and can affect the decision on what types of assets are used to fund the trust and how those assets are invested over the term of the trust. So the way that this works, the tax due upon distributions to the non-charitable beneficiaries is based upon the type of income that's generated from the underlying assets. And the type of income distributed per IRS regulations always starts first with ordinary income, then capital gains, then other income, including tax-free income. And you'll see that the income subject to higher tax rates must be distributed first. So if you're interested in learning more about this, I'm going to link below to the IRS website that will go into a little bit more depth. The good news is that the transfer of the remainder interest that goes to charity is, of course, exempt from tax altogether. And I also want to mention that this is very much a simplified overview of these types of trusts. There are several variations that offer flexibility in terms of payouts from the trust, which might be useful to offset high or low income earning years, depending on the unique circumstances of the person who's setting up the trust. So that, in a nutshell, is a general overview of charitable remainder trusts. And I mentioned at the beginning that I would briefly distinguish between charitable lead trusts. At the most basic level, the difference is quite simple. After the trust is funded, instead of annual distributions going to non-charitable beneficiaries, the annual distributions instead go to charity in a charitable lead trust. After the term of the trust, whatever remaining passes to the non-charitable remainderman. And I'll just note that the tax consequences are similar but not identical to a charitable remainder trust. It's essentially the reverse of a charitable remainder trust. The charity gets the lead benefit in a charitable lead trust, and the charity gets the remainder benefit in a charitable remainder trust. I hope that you found this information useful. If you did, please let me know. Please consider subscribing to the channel, and I'll hope to see you in the next video.